All right. Greetings, everybody. This is Jeff Scott, and welcome to this week's review. It is almost the 6th, so we're just going to leave it at that and get going. I entitled today, Markets Melt Up, which is pretty descriptive, I think, of the markets over the last week or so, although it's not been fun for everyone or every stock, as we will talk about. My email address is hgsidoc@gmail.com. And hold on one second. And if you have any questions, just email me or leave a comment in YouTube under I think the show remarks or there's a button to get more things. I do not keep a mailing list. I post this in a number of various boards. I post it on YouTube as a convenience. I also keep a Dropbox link that I send out, and I keep that link active for about a month if you want to download it. This is in 2560 by 1440, so you should be able to read it without a 4K monitor. Unfortunately, I could not get my mic to work right with recording, so I'm using this. I got introduced to a great Skype chat room from Zazen Capital. Look it up. I'm not sure if there's any more spaces there, but it's sort of the greatest hits of folks that I've followed over the years from the Palatuma board, old HGSIers and others. So it's been kind of interesting this week, and thanks for them for letting me join their group. Let's go ahead and let's take a look. Disclaimer, this is for education purposes only. Any recommendations for education, not investment advice. I'm a doctor, not a broker. I am independent. I pay for all the tools that I use, and trading involves risk, and you alone are solely responsible for any investment decisions you make. My trading style, I call it be your own guru. I started with CanSlim. I think it was improved by Ian Woodward over here and by Gil Morales and Chris Katcher. My buddy John Person has some great tools for finding out when to take the trade. Van Tharp for position size and money management. George Lee, may rest in peace, just a great trader from Western Canada that I got to share the podium with frequently, miss him dearly. Mark Minervini, I've been to his live program several times. And then Sagar down here at Superior Profit also has some great tools. So these are just some of the folks that I've learned from. And for me, it's about figure out what works for you, get exposed to different people, and then come up with your own version. And that's what I do. I own a lot of software, but in reality, what do I need? I need TradeStation with a number of indicators, John Persons, Sager's Q tools, Dr. K tools, Thinkorswim, also with some indicator sets. I do most of my analysis during and after market with HGSI and EdgeRater, and Q's got just some great spreadsheets, but you have to have Refinitiv or Metastock data to use those. From time to time, I'll introduce you or bring on somebody who is a vendor that I like. I like what they do, and I'm never paid by them. I don't take anything. I'm an unpaid volunteer, and this is just education. Again, unpaid volunteer, no ownership, no control. But here's the website for HGSI, free 30-day trial. Under investing strategies, you'll see hundreds of movies by myself and others. I will say that the program is not always simple to use right out of the box, like there's boxes anymore in this land of digital. If you are new to HGSI, I've got some videos that help to explain it, as do Ron Brown. Stock patterns are cyclical. Think here, the end of March, we're throwing darts at certainly growth stocks. You would have made a ton of money. And then, it certainly felt in September, parts of October, November, that maybe we were slowing down. There was rotation into other groups, some of the beaten down stocks. And then it felt to me like we were rolling over. And just as I thought that the market was done, it takes another leg up. So now, have we started a new stage 2 with markup? Or are we just resuming the existing stage 2, which is, I think, what we're doing? And what I've seen in a lot of markets, as soon as they look like they're falling over, there's uncertainty, then you get another leg up, and that keeps going till it doesn't. Eventually, we're going to pay the piper, and we're going to get a stage 4. Remember, the stocks that I talk about, these growth stocks, they may go up like a rocket, but they fall like rocks. Based upon where you are, you have to decide how to play the market. Last week on Wednesday, I turned more bullish, which meant I took more long positions. I covered my contras. I still have some puts out there, but less than I did a week ago. And I'll be quick to put them on. I'll mention later I'm very much in protecting capital mode right now. Here is a end of day Friday sector review. Now you can't read it, don't even worry about it. It starts off with some futures. We can ignore that in sector ETFs. But this is materials, this is energy, this is financials, this is industrials, staples, technology, discretionary, utilities, healthcare, communications, real estate. And then here, starting right here where it says market, this is the Market Smith 300. So the first thing is it's a predominantly green market this week. And where is the weakness, if there is any? Utilities. Staples a little bit. Look how strong financials are. Look how strong energy has been. Here's financials, and here is energy. Everything was green in energy. The big thing that happened in energy this week, I think, was OPEC compromised on how many more barrels, and they upped their forecast of use because of recovery. Major markets tell a story, so let's quickly go look at those major markets. And I'm using Thinkorswim here, and there it is. Let's see if I can make this bigger so you can actually see it, although it's not too bad here, is it? Make sure it's on the daily, maximize sell. So the first thing is you're going to notice that on the futures, you're going to see this white bubble here either on Friday or Thursday. That tells you that the high of the year, because I'm looking at 1 year's worth of data, occurred this week. In fact, closing highs on the NASDAQ, Dow, and S&P as well. The low of the year, here is that great buying opportunity on March 23rd, and we've had just a massive run off that bottom. You've got the price over the 17, over the 50, and the 200. We'll talk about how it's getting extended, but except for the extension, we broke out from the prior high. It looks great. It can get to a point where it gets so far away from this 200 moving average or the 50 that you know a pullback, or at least a correction, is coming. NASDAQ, the same thing, had a closing high on Friday, but the intraday high went a little bit higher on Thursday. Not much different to say. These blue arrows here are John Person buys, those are John Person sells. Here is the YMs, the Dow futures, and you can see new highs. And we've taken out the March or the February highs as well, and then consolidated there and then broke out last week. So again, very bullish looking, but maybe too bullish. The Russell, this one lagged compared to the others, and frankly, between June and September, it just went sideways. But boy, has it come up since then. And notice you had a John Persons indicator fired right here on the 200. All these are in buy signals. All of them are at all-time highs. This high back here in February and March, or February and January, was not all-time highs on the Russell. It was for everybody else, but the Russell's not at all-time high as well. So you look at this, hard not to say the market's strong, but maybe it's too strong. The VIX did not really budge higher this week. It went sideways all 5 days on the daily. And if I look at the dollar had a green candle low. A green candle low means it opened here, closed above it, so that's a green candle. And it was the lowest. Look, there's nothing to the left lower than this going back a full year. So that can be a reversal candle. So we'll see if the dollar strengthens or rebounds a little bit. It's looked like it's done that before and it's continued to fail. So we'll have to see. Now, if I switch this to the weeklies, which I don't always do here, but I think it's important because just to see how strong these markets are. And markets don't go up forever. And you notice you have new weekly highs on all indices. So I guess you did get a daily and a weekly on the Russell as well as everybody else. Weekly high, weekly high, weekly high. These are all-time highs. You can see the weekly didn't do much on the VIX this week, and the dollar just a bearish looking candle. So markets are strong, and I've mentioned several times maybe too strong, and I'll show you data to support my thoughts as we go forward. For those who are new to me, I spend a lot of time on the market because I'm a top-down guy. And I'll look at stocks at about the 30-minute mark. But to me, the biggest question is, am I long, short, or on the sidelines? And this is a very strong market, but what else can I tell you? Underneath, rates, I hate to say shot up, but they rose a lot this week on both the 10, 30 years and across the curve. What does this mean? It means it's good for, rising rates are good for banks, especially regionals and insurers. Now, the energy was so strong that even the MLPs looked good. Price and AD lines are at all-time highs. On the left are the small stocks, on the right, small and medium stocks, on the right are the large stocks. And if you look at the NYSE, you could see the AD line on the NYSE in white is at all-time highs. You could see here I've got a number of ETFs all following it higher. And the only ETF that was weak, no surprise with rising rates, was the TLT, the bonds. Now, I like to look at stocks above the 200-day and above the 40-day SMA, and you're approaching 80% on both of those. This is huge. And if you go back, I mean, these are years here. We are the highest amount going back to probably 2013 on stocks above the 200, and all the way back to 2009, 10 in stocks above the 40. So this is a very extended market if you look at stocks above their moving averages. This is a 3-month new high, new low on Warden TC2000, the T2121. And whenever I get above this white line or near this white line, I expect the market is going to reverse. When I get to the bottom white line, I've seen dramatic, in yellow, you can see the S&P just moving up here. You see the S&P turning down often when we get up to the top. We're at a point where you'd expect the market to reverse. Now I'm going to put an asterisk on that and talk to you about it later. The McClellan new highs on the daily, we're not on new highs yet on the oscillator summation index, certainly not at extremes either. There's been no zero line reject. If anything, there was a positive one back here. So is this a divergence where we don't have new highs there? I think maybe it's just too early. But it's concerning. Same thing on the weekly. Let's move forward. The buckets. This is something that Ian Woodward taught us. If you take the stocks in the S&P 1500 and look at them, you'll find that 85% or 83% are above the midline of their Bollinger Bands. That's bullish. If I look at how many stocks are above or below and where they're distributed, I find that most of them are in their upper half of their Bollinger Bands, as this tells us, but we don't have 30, 40% above the bands. That makes me feel a little bit better about the timing of a reversal. The Hindenburg-Omen, something else I learned from Ian Woodward. Boy, I miss him. This is a sort of a old, not wives' tale, fish tale, but it's something that not everybody believes in. And it's signaled by things such as new highs, new lows, rising moving average of the weekly NYSE, the McClellan less than zero, and the number of new highs versus new lows. And there has not been a major market correction since the 50s that wasn't signaled by a Hindenburg-Omen firing. The problem is you get a lot of false signals. You also don't see one until you're at new highs. So now it's time to think about it. But if I look at it, this would be the line that would show up. We've had no Hindenburg-Omen for 5 months. We did have them before the market corrected in February, though. If you look down here, I got 10% of my plus of the NASDAQ, almost 11 are at new highs, 11.7 of the NYSE. And if you look at prior times, this is about where we were in January, February, before the market rolled over. So more evidence of extension. Market tone, this is the Woody indicator of a number of indexes. You can see it's all green. That's great. Interestingly, this is showing the profound volatility we've been in. That actually eased off this week. This, I'm going to spend a couple seconds. On the right is a tool that I can use in Hgsi and take lists that I generated last weekend and see going forward how they did this week. I can see that my overall holdings, had I not changed them, this is looking at what I had on Friday, would have been up this week a little bit, 1.43%. My buy watch list didn't do so well, was down 0.43. My filtered list was up 0.52. So I always want to know how I compare. So I like to compare myself to IBD and MarketSmith. The weekend review was up 1.66. The MarketSmith 250 was up identical to me. And let's see, somewhere the IBD 50, I thought I saw it here earlier. Hello, where did you go? It's probably right in front of my face. Here's the IBD 50, was only up 0.64. You could tell there's a high correlation to those stocks because I'm a growth stock guy. The S&P 500 was up about the same as the weekend review at 1.65. Now, the next chart's a little bit more confusing. If you're a growth stock investor, then you like earnings per share growth, which is the E. You like relative strength, the R, and you may like over short-term G, which is group. If each score can be between 0 and 99, if you have 399s, you've got 297. So this graph on top looks at the ERG score versus the return. Now, the number of stocks in the last three circles or the first three circles is very small, so I don't count those. But when I look at this, it looks like the junk actually outperformed this week. Not a surprise. Here's stocks and groups moving to the downside. They were up 3.46. Here's stocks with negative earnings growth. Here's stocks, bottom fishing stocks that were beat up. They were all up 6.25. So this was a reversal week where some of the lousy stocks worked. But then again, the blue dot, high relative strength stocks worked as well. So a little bit of a trend higher in the low ERG stocks, but the vast majority of stocks, except for a few of the high growth stocks, did very well. If I look at EPS rank versus return, turns out this was a good week to have no earnings growth because they outperformed. Relative strength, pretty much the more you had, the better you did. Stocks that were accumulating last Friday actually outperformed, and the boxes don't give us a signal. Sector strength shows some weakness in utilities, no surprise, and staples showed some yellow, but overall pretty strong. Now this comes from Sager's Q Tools, and I love this real time because there'll be another column here which is real time data, but it shows me on the S&P 1500 sectors that over a month all the sectors have been up. That we stumbled a little bit this week. You could see 5 days there was at least one that was negative, but for the most part this has been a strong month. Here I could see that the majority of industry groups advanced this week or yesterday and on the week. 85% very strong. Again, you saw the AD lines. And stock advancing, the vast majority of stocks were up. So a very strong, broad-based rise. And when you look at sector performance, you could see over the last month, energy's been up 52.6. And you could see over the last month, all 11 sectors were up. If you look over the last 2 weeks, only one was down, and that looks like it was utilities. And if you look over the last 1 week, again, utilities. No surprise, you'd expect a defensive group like utilities to lag here. Now, if I look on Friday, again, this is within the Q tools, and I can update this real time during the day. Energy, materials, IT lagged, and the weakness has been, no surprise, staples and utilities. Now, if I looked at energy, if you notice, energy's been strong now for 3 months. It's been the top group over the last 3 months. Now, if I look at what groups are leading, exploration, production, equipment and services, integrated oils, drilling, oil and gas refining, I've only got 147 groups in this, and 1, 2, 3, 4, 5 of them, 6 of them are in the top 10. The laggard, no shocker, is coal. Now, I created, after it was taught to me by Ian, a group called the Canaries, and these include Tesla, Apple, Amazon, Netflix, Bookings, now Google, only one of the Googles, Baidu, and Facebook. And look at the weekly charts going back to 2016, and you could see just a massive acceleration in the Canaries over the last couple of months of this year, and really ever since we bottomed in March. We're at all-time highs on the Canaries. You need to know your news and earnings. News is mixed. We got some credit, labor costs, job openings. Thursday, we have jobless claims. That's probably a market mover, although this week we were kind of weak on employment and the market loved it. And then we got PPI and some consumer sentiment on Friday. I think the big news is going to be vaccine status because we should be getting close to having one of those meetings where the FDA works towards an approval. I think we'll continue to have the concern about the COVID explosion and whether or not Congress puts out a stimulus bill. Earnings, this comes from earningswhispers.com. There's a lot of interesting earnings this week. I don't think I have a whole lot. The solars have been up, down of late. Jinko Solar has something on before they open on Monday. Toll Brothers may give us a sense of how the builders are doing. A lot of interesting auto parts stores. Here's AutoZone. Chewy, my dog loves their boxes. They come with treats. Cons, unfortunately, I have a position here. It's really done nothing for a while. Restoration Hardware, Adobe, Sienna, Costco, Broadcom, Oracle. And as I put down here, and this is my quote, although I'm sure others have said it, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So, wordy. As I showed you, new highs on Friday, energy led, growth and value both did well this week. NASDAQ was the leader, followed by the Russell. You can see year to date, the euphoria on Q3 for economic recovery seems to be meaning or over it should be the overhang against the market going down because of the explosion of COVID, shutdowns, employment, and continued failure of Congress to pass stimulus, as well as all the attempts by POTUS to overturn. I remain very positive on the year. It's probably one of not my best year ever, but one of my best. I started the year with 1.4 million in my trading account, and I'm up over 175%. That's my current. I'm actually off my highs, and part of that's because I got chicken over the last couple of weeks when the market was turbulent, and I bought some puts, which cut down on my performance. Again, I increased my long allocation this week after a near bloodbath, and it's funny, on both Monday and Tuesday, my account was down a lot, but by the end of the day, it was almost back to break even. I still think we correct before Santa. I base this on measures of extension. I've shown you some already. I'll show you some more. But extended markets can go higher. And based upon the last few weeks, we might just see continued rotation and attacks on individual industry groups. Improvements in financials, semi, and biotech and leadership cannot be a bad thing. Then you have this question. The surge in energy and some of the other COVID hurt industries, airlines, hospitals, REITs, cruise lines, restaurants, are they overstating the extension because of these big rallies while they still remain very much off their past highs? It's a question. Trade the market we have and get and let that determine your stance. And all my opinions are my opinions alone and may change before Monday at 9:30. Now, that's how I usually start looking at the market. Obviously, been going on for a while. Now I'm going to go take a look at what I do to look for stocks. I start with, again, the market. In TradeStation, I always do this every day. I've got 6 things I'm going to look for. This is the E-mini futures. First thing is, am I in a person buy or sell? Daily buy, weekly buy, monthly buy. That's bullish. What's the color of my paint bar? These are Alexander Elder Impulse Indicator. Green, I could be long or holding. Red, I should be short or holding. Blue, I can do whatever I want. Green, green, green. Bullish. Where is my location? Well, I'm riding up the upper envelope. But to be honest with you, it does it all the time. So that doesn't bother me that much. If I get way outside the envelope is a different story. Then I look at these red dots, and sometimes you'll see green dots underneath. And these tell me that I probably got some MACD divergence. Well, it's worked off on the daily, but I've got some MACD divergence to be concerned about on the weekly. You can see the MACD here, and you can see the MACD here just barely turning positive despite bigger highs. All right. My best timing indicator is this weekly bongo. It's still green. That's awesome. And then I look here at the high jump indicator, and I could see it's at 80. It closed the week at 90.15. That's getting to the point where markets turn over. If I go back here, which was a clear, you could see it was at 100. Here it was at 81, and then this day was at, it's because it corrected that day, 70. So it gets up, but at 100 or anything above 95, I expect a correction. So we are right about there on the E-minis. Real quickly, Dow futures will look exactly the same, except they're below their envelope, and they're at 83%. The Russell futures are, again, above the envelope, have the red dots, and they're at 97.67, so they're very extended. And then the NASDAQ, red dots in blue, all in buy signals, and it's at only 65.51. So again, evidence of extension, especially on the Russell, but that doesn't mean it has to roll over. Now, the beauty of HGSI, in my opinion, is the speed and the fact that the data resides on my computer, and it allows built in some analysis that would have taken me a lot of work, like in Excel. If I actually knew what I was doing in Excel, I have to usually pay somebody to do the work for me. So let's look at major markets. Hit the warehouse, and they're going to pop up here eventually, and you're going to see that I got 28 groups here. And I rank these 28 groups by T1, which is just a price and volume top-down ranking system. And I make sure that I'm listed by raw combo, and I can see small caps, mid caps, NYSE, Russell, NASDAQ up at the top, biotech, semiconductors. I know I made money this week because those are where I live. And what was doing poorly this week were bonds, volatility, Utes, dollar, gas, commodities, gold miners. Interestingly, the strength above was so strong that even though the IBD 50 index was up 0.9 on the week, it's pushed way down compared to the 6.8% on silver, the 2.7 on gold, but more importantly, the 2.4 on small caps, and so on and so forth. So that gives me a sense that growth is probably doing okay. So let's find that S&P 500, and very quickly, I'm going to go through those. For those that are new to me, that are wondering what all my indicators are, I'm not going to go through that today. But if you send me an email, I'd be more than happy to share with you a video and a PowerPoint presentation of the vocabulary of what I do and what I use. There's a lot of things here. Just remember, and this is sort of simplistic, blue and green are good and red is bad. So S&P 500, a couple different things. I mentioned the Hindenburg omen. We haven't had one. If that's white, there isn't one. But if I go back to the left, I can find that before this market rolled over, I actually fired a big Hindenburg here. So that would have been a signal to be concerned. Now, that wasn't that big. Here's back in August of 2019, had a Hindenburg. But if you go back to the big market corrections, so here's one where we didn't fire. That was in 18. But if you go back to the major corrections, here's 2014, multiple firings. But if I was to take this back to 2008 and 2007, it'd be like painting a brush. If you knew this was an important signal and you were sitting at home and you saw those fire, you would know the market was at a point that you need to be concerned. So I like the Hindenburg. That long-term indicator, the weekly bongo, is the next thing, which is green. This is accumulation distribution. This is that high jump I was talking about. Then I have Bible gap ups, squeeze, mobile breakouts. On moving averages, I got magenta, which is an 8-day exponential, and then 17 in green, 50 in blue, and 200 in red. Simple moving averages. If you see, you won't see it here. I'll show you a industry group line when there is an industry group. This is persons buy-sell indicator down here. This is when it turned as a buy. Person market catcher, which I'm not going to spend any time with today. These here, Eurekas and Phoenixes, are the HGSI synonym to the O'Neill follow-through days using math. And then below that, kahunas are just big outside moves. So if I take a look at the, let's get a little bit more data, a year's worth or so of the S&P 500, we've had a great recovery. I think what I wanted to point out is this dashed line there that I just highlighted. I think that's the 127% extension, and I wonder if that's going to be something that we need to be concerned about. This dark line here was the prior high, but we're coming into a fib extension. That would be a natural place for us to slow down. The high jump, we already talked about, is pretty high, but if I want to look at it another way and want to be bullish, my 8's above the 17's above the 50, which is above the 200. Nothing wrong with that. I'm in a buy signal. So, yeah, I think this market's going to roll over. I think this market's going to correct. But I'm going to wait till that happens before I get crazy and change what I'm doing. You can see how strong the weekly is. If I take a look at the Dow Jones Industrials, same exact story. We've broken out above prior highs, new closing highs, in a person buy, perfect setup of the moving averages. Yes, extended, but extended markets can get more extended. Speaking of more extended, you could see the big move on the Russell off the low here. It's just phenomenal. All-time highs, great setup of moving averages. Yes, the high jump bar is pegged. That's concerning, but all in all, strength. And then if I look at the NASDAQ, also at the top of its range with a perfect set of moving averages. Again, do I expect a correction? Yes. Do I know when that correction's happening? No. Could the markets be higher in a month? I think they will be. Have I sold all my longs? No, I have not. I'm just hyper aware and watching for evidence that something has changed. We've probably been looking for a correction ever since this line was drawn here back in May. We haven't gotten it, or we haven't gotten a significant one. We've continued to go higher. We've had lots of little pullbacks. The IBD 50 has not retaken. This is a 50 ETF, its prior highs. The FANGs are, this is an ETF or an ETN, I believe. And I like to look at this as well. Again, approaching all-time highs for this ETN as well. FANG stocks have been leading even with the intermittent market rotations. If I look at the dollar, it's in the dumps as we talked about it. Now this gray bar here is something that Ian developed called the bingo. And the bingo is sort of the baby out with the bathwater signal. It can lead to a bottom, but you need to see some bullish signals come in afterwards. We haven't seen those yet. The VIX has come down and really hasn't done much, as I mentioned. It's getting down to where it was even before February, but this is a place where it likes to come up from. But again, you got to wait till it happens. You can't, because you don't know when it's going to occur. Gold was up for the week, and you could see gold has bounced. Now, gold still has a long ways to go. It's still below its 50-day moving average. You can see the weekly bongo is red. With the dollar week, I would have thought gold would have taken off. Perhaps it's a risk-off environment, and so you don't need to hoard gold. Silver, similar, maybe a little bit better, sitting right about on its 200-day moving average. And then gold miners, again, right on the 200. So gold hasn't been that exciting of a place to be. All right, let's look at industry groups. Hit my warehouse, and you can see I've got 175 groups. I like to rank them on the 2-day force. Alexander's Force Index, you take today's price minus yesterday's price times volume, and you plot it. We measure a 2-day and a 13-day EMA, and I also use a 5-day EMA sort of as an intermediate. And then I rank them by their force. No surprise, with energy being the leader on the week, my highest group here is exploration and production. Of my 175 groups, 84 of them are to the upside short term, and only 3 are to the downside short term. On a longer period of time, I've got 10 groups to the downside, and I think I've got 84, 83 to the upside. So this is a very bullish picture. Usually this will turn around as a market corrects. Now, top-down investing, I highlight that expiration. I right-click, left-click, change index group, and the top stocks by force come up to the top. So here's what I meant about huge moves. So this is Occidental Petroleum, which actually looks interesting to me here. Not a growth stock by any means. It is up from its lows 114% in 25 trading days. Man, that's extended. Yeah, but look how far it's down from $84 plus, now down to 18. That may be confounding some of my measurements of extension. As I look at this, it broke above the 200. It retested, is going higher. I actually like this if I have to like something in this group. And let me bring down, hold on a second. Nope, that's not what I want. This is what I want. And I could see it pays an 8.6% dividend. I haven't really become a income investor overnight, but if you're going to be nibbling in energy, this might be a place to consider. You got a nice dividend to buffet you, and it's it looks like it's in a nice bounce, and we know oil prices have stabilized. The next one's ConocoPhillips. You could say the same thing there, 3.8%. EOG Resources looks the same, 2.7. I bought Diamondback when it broke up above the 50. I've had a nice return on it. Again, the same exact pattern. A new buy signal came in on Friday, 3.2% dividend. Earnings growth sucks in these. Their revenue dropped with the slowdown, no surprise, but it still makes money. And the market's a discounting mechanism. So if it thinks the market's going higher, it may be ignoring the current earnings slowdown. Here's Callon Petroleum, big move this week, way off the bottom. Here's that group, that dark line, that's a group. I have no problem buying these stocks. You just know what you're buying. You're buying stocks that have been beaten down, that are in the recovery phase, that technically they've now broken out above the 200-day moving average. I think there's a high risk that we have a slowdown because of this COVID. But do I think we're still going to use oil? Yeah, so that's why I started nibbling. So I could go through the whole list, but they all look like this. And, I bought Diamondback, I bought PDCE, and I'm probably going to buy some more Hgsi this week. I like what it's doing. So energy's been strong for a while. I think we all know that that's really dependent upon growth, the economy. It may be impacted by the Green New Deal that we might see with the Democrats in control. But energy right now, trade what the market you got, not what you think you got. And right now, energy looks good. The investment companies, a lot of these are blank check companies, and I have a hard time with them. I just don't know what to do with them, so I don't buy them. So the charts are phenomenal, but they're phenomenal up, and then they come down too. I look at these, and this was a great move up, came back down, now it's going back up. Some of these are buying battery companies. Some of these are buying electric motor companies. I would say use at your own risk. You're not buying something based upon a long-term chart pattern or fundamentals. You're buying it because of, right now, SPACs are exciting. Application software. Here is DocuSign. Big move up, sideways, Bible gap up on Friday. What I like to buy, frankly, are long uptrends that go sideways, catch up to their 50 and break out with momentum. The problem is I don't like where it closed. But DocuSign looks interesting, and I'm going to watch that. I've been in this stock forever, I think I was in it since the $30. And this stock just keeps on going, and it had a big move up on Friday. I guess it's got a banking license in Singapore or something, an e-commerce play, C Limited. The problem today, and this is a problem I think of the market as a whole, I can buy Hgsi and not feel bad. But boy, if you're buying something like this, that's gone from 45 to 200 in 6 months. You're buying stocks that are extended, expensive, and high risk. Now, I know that's what growth stock investing is, but at settings, if you agree with me that this market's in a tenuous area, I'm careful with what I'm buying right now. So I love the stock coming out of a squeeze, Bible gap up, a kahuna, John Person's buy signal, everything I could possibly like. It's just really expensive. But that's what's been working. Look at Shopify, look at others. PagerDuty, Bible gap up on Friday, closed in the upper part. If you follow Morales and Catcher, you know how to play those. BlackBerry. So a lot of these, this is one that looked interesting to me. Now, this might be more, and I'm going to just, here's the other side of the coin. Here's a stock that's got earnings per share growth coming. This is this quarter and then the following quarter. Here's your next earnings date. This tells me it's under demand. It had a kahuna and a John Person buy, but this is a laggard. So in fact, if I'm buying stocks that haven't broken out and run, I'm buying laggards, and that maybe is not something I want to do. Activision Blizzard, I like this one. Pull back at the 50, and I look for how many of these momentum. A squeeze, a mobile breakout, John Person buy, a pocket pivot, and a kahuna. I like this one a lot, Activision Blizzard, and that's on my buy list. So I go through the top 10 groups. That's what my top-down investing piece is. And let's just look at semiconductors. Boy, I wish I owned Micron. I don't know. Should have bought it here. Broke out above the 17. Had a kahuna, pocket pivot, John Person buy, mobile breakout, and a squeeze. That's what I look for. Now, why didn't I buy it? Because I can only buy so many stocks. It's got earnings per share growth greater than its multiple. I like to see that. The industry group obviously very strong. And this green bar occurring the same day it broke out said another leg of the market up was starting then. So that would have been a great opportunity. Qualcomm, I've been in and out of this. It would have been much better to buy it down here coming off the 50. It's getting a little bit extended. But what a great stock and great earnings to come. If I still owned it, I'd be happy and holding on to it, just like my C. I'm not sure I'd be buying more of it. AMD, a little bit less extended, but here you go. Big move up, sideways, and breakout. That's what I like to trade. I think AMD looks interesting here, but it's run. Intel's down in the toilet. NVIDIA is interesting because this is exactly what I want to find. Big uptrend, sideways move sitting on the 50. Had a mobile breakout from a squeeze. David Elliott was the mobile breakout guy. It's in a John Person buy. This one's close, so I have this on a watch list. I'd like to see it take out the Wilder PSAR, but I love the pattern, and that's what the type of thing I like to buy. Down the list, I also like Skyworks here. And you could see similar pattern, uptrend, sideways. Here it's got some a breakout. Broke above the PSAR, broke above its chandelier stop. Pocket pivot, kahuna, John Person buy signal coming out of a squeeze. So Skyworks looks good here as well. Electrical power. And now I said a couple weeks ago I wouldn't buy GE. Maybe I should have bought GE. I still have a hard time buying GE. GE's broken out. Again, it's up at the top of the high jump. Maybe it's cheap because it used to be a $40 stock. I'm not buying it. I know some of the people that follow me have been in and out of Blink. Blink has pulled back. I'd be out of Blink right now. I'd be watching it, and maybe it shows more momentum, but right now I wouldn't be in Blink. Midstream oil and gas. I was surprised to see this with rates going up, but if energy's stabilizing, you have a whole host of stocks that look like Energy Transfer. They look like this, breaking above the 200-day moving average with lots of momentum signals, pays a huge dividend, and you could see here that, excuse me, in green is the dividend that they've been paying. Here's their dividend yield. So that's ET. It looks like they must have cut their dividend, that last one that they paid. Williams Companies breaking out, got a little bit of growth and the 7.0% dividend that has not decreased. One OK, 9.2% dividend, has not decreased. Kinder Morgan, 6.9 dividend, has not decreased. So these are pure dividend plays. Some of them have growth, like this isn't a bad looking chart, Plains All American, 9.3% dividend. And it looks like it was, it looks like it's been steady at 18 cents a quarter. Cheap stock, that's why it's 9.3%. So none of these are going to be great. Can Slim cup and handles are wonderful charts, but you've got breakouts from beaten down stocks with dividends. I just think with the strength and energy, it's not wrong to have something. Specialty pharma, nothing is as strong as its index, so I don't usually bother with it. I will pull out Exosome. Why? Because it had some interesting news, and when I see two kahunas in a row, and the stock breaks out of mobile breakout from a squeeze, and the weekly bongo turns green, I pay attention. They've got some interesting headache medications coming. Truth be told, I have a position in it, so I'm talking my book. That's why I'm telling you. Steel raw materials, probably getting too late to buy these, but look at these moves. Woo, 3.4% dividend. It's ran from 11 to 16 in a month. Vale, Rio Tinto, Cleveland Cliffs, BHP Billiton. Steel raw materials look impressive, so has steel. Airlines, right, looks a lot like oil and gas. Stocks that were beaten down, that have now broken above the 200, a little bit of a test, and are going higher. Industry group has turned up after doing nothing. Does not pay dividends, but you can see here under huge demand. There's a lot of hopium in these plays, and by hopium I mean we're hoping that the market recovers, that the airlines come back to normal. The crazy thing is they go up despite secondaries. They didn't get the money they wanted for the government, but they've been issuing secondaries, and the stocks continue to go higher. So again, you're not buying anything here because the stock charts are great and the company's got great earnings picture. You're buying it if you're a value guy and you think these things can't get any lower. Probably the nicest chart was on Delta here. It's already moved up some, but it's got horrible fundamentals. Pays a teeny weeny dividend, which I don't know why they or how they could. And I bought some JetBlue, and then it had a secondary and came right back. Banks, regional banks, with interest rates going up, you expect them to be high, to be doing well. And these things broke out. I started talking about these things probably a month ago, if not more. And you can see these things have already run up quite a bit. Hard to chase these. I did like Fifth Third a little bit, but they're all about the same. This pays 3.8% dividends, got some great earnings. And what I told people to buy was to look at KRE, which is the regional bank ETF. And it looks just like the stocks. So typically I'll do the top 10 groups, and that's when I'll go and do a couple of my favorite searches. For example, if I go down here to this, go to all securities. So I'm taking off all my price and volume filters. And maybe I'm going to filter by 5 and 500,000. I don't like to buy stocks that are hard to get rid of. And that drops my 93, 95 down to, come on. I don't know what I did is taking so long, probably because I have the charts open. Hello, 1992. Let's hit the warehouse view. That brings them over there. Now let's do a couple of things that I like to look at. I might want to look for uptrends. Free parking to me is stocks that are pulling into the 50. So how about if I find how many stocks are pulling into the 200, are in a squeeze, and have momentum. None of these may be good, or they may all be good. Let's see, because you got to be pulling into the, you've got to be within 2% of the 50-day moving average, and you got to have momentum. I don't like the picture here. It's a mortgage finance. Some of them looked okay. Capricorn, no. Cardiovascular system, no. Acoustic technology, no. All right. So then I'll say, all right, well, if I take off the squeeze, maybe let's just look at how many stocks are uptrends pull back into the 50. There were 28. Usually there's a lot more. This requires a couple of other momentum things. But you see things that I like. Here's NVIDIA. I already talked about NVIDIA. O'Reilly Automotive, it's a $540 stock, but excuse me, a $450 stock, like NVIDIA, Expeditors. So these stocks are all going to be around their 50, and they're going to be having some of my momentum indicators. So I'll typically do that. I've got other things that I will look at. I will look at somebody. I'm not going to give any more info, so it's his business, not. But Tom sent me something a while ago, and he's got a filter that really finds great stocks. Ambarella, remember this with GoPro, $120, $130 stock, and then went back down the teens. It's back up to almost 100 again. So I'm using different scans to find some of the leading stocks. Novacure, it's funny. My son is a new trader. He's a Robinhood trader. And him and everybody else I know, because I'm a cancer doctor, called me up Monday, 2 weeks ago, and said, should we buy Novacure? I said, you should have been calling me on Tuesday the 3rd when it pulled into the 50, which is when I bought it, and not when it was already giving me a doji up here. No one talked to me again, and now it's at all-time highs. So Novacure, what am I looking for? Pull back into the 50 and break out with momentum indicators. So with Hgsi, there are a number of different scans that I can run. Let's see. And I'll do that from time to time as well. Now, I will also look at other programs. And for example, within TradeStation, I have a number of scans I run every night. And some of these scans are just amazing. So this is something from my buddy Sager. And this is looking for, make sure I get my bulls and my bears. Stocks that are pulled down to memory support. So these are stocks pulling into support. On the weekly setting. So let's look at, what do I want? TG Therapeutics. So these stocks, by definition, have pulled into support. Okay, this is an automatic trend line. So I might combine. All right, I can look at stocks that have new John Person buy signals. Every stock here has a new John Person buy signal. I could look for weekly signals. There's a number of different things I could do in my scans. What I do on the weekend is I take the results of most of these scans, bullish or bearish. I combine them with a number of lists that I get from various sources. So those of you who are fans of IBD and MarketSmith will probably recognize most of these searches. And then I've got searches in HGSI. I take all those stocks and I put them into a couple of different lists, and I call it my consolidated buy list, which is right here. And this week it was 1171 before I trimmed it down with price and volume. And then I ended up with, take this filter off here. I ended up with a lot of stocks. I think there may have been 1,171 stocks were in the $500,000 and $500,000 range, which would be fine, the same, because that's the filter I put in there. So I looked at all those 1,100 stocks, and I combined my top down with a bottoms up, which is looking at all these stocks in these various groups. Not the combo, consolidated, Jeffrey. Here it is, 1171. And I generated a list of stocks that I'm going to be watching this week or watching on Monday. Now, I am not building a list of the best stocks in the market. What good does it do to tell me what I could have, should have, would have bought? I'm trying to build a list of stocks that might be reasonable this week, stocks that I might want to follow and look for new breakouts. So let's look at, I'm trying to figure out the right view here. Okay. Let's look at the industry groups. Agricultural chemicals. Mosaic, I bought it last week, 10 days ago, had a nice run up, flag, and it broke out again on Friday. I like Mosaic. Look at the earnings per share growth here. All right. A lot of these we looked at. Datadog, semiconductor stocks, technology stocks. This is an application software. Uptrend sideways, and what happened on Friday? It broke out above the 50. Look at the industry group. I don't like the earnings. Next earnings are not out to the 11th. What else looked here that was in a Bible position? Hgsi has been one of the big winners of the run up with the stay-at-home model, and I bet they have a great Christmas. They've got great earnings per share growth. Look at the earnings per share growth here. Yes, slowing down a bit, but pretty phenomenal. Look at its PE. If it makes those earnings, it goes higher. It's under demand. I like that. There's that Axosome. A lot of the stocks we've already looked at are here. Kansas City Southern. Again, it's just my pattern. A stock that has been in an uptrend. Here's 104. It's now up to 190. And what happened on Friday? Mobile breakout from a squeeze, a new John Person buy signal here, and a kahuna. It pays a small dividend. So these are some of the stocks that I found on my review. Again, many of them I've already shown you. I'm looking for stocks that have pulled back to support and have momentum. Sometimes I'm going to look at a stock like Tech, which I think may have more to run, which has already broken out. In this case, I already have some. I'm looking at buying more. Techminco, look at the earnings per share growth coming in. And so you're probably thinking to yourself, who is this guy and how can he watch 58 stocks? I don't have to watch 58 stocks. If I'm a thinker swimmer, I can go into my my scanning side, my market watch here. I can go, all right, let's take import. Buy watch. Okay. Now let's let it do its thing. And I did it wrong. Or you know what? I haven't filled that. Okay, let me fix that. All right, let's try that again. I forgot to set up the file that I imported from. Select file, buy watch, hit OK. And here's the 58 stocks that I found. And then I have in my buy watch, I have a buy sell indicator here. I have a kahuna. I talked about that. I have high close and low close dojis. I've got pocket pivots, Bible gap ups, and a number of other indicators that I use as well. So I can leave this here. I can look at stocks, what they're moving. I could set alerts, and I don't have to be watching all those charts. I let my tools do it for me. In TradeStation, it's called Radar Screen, and I set up a large radar screen with a large number of stocks that I want to watch. And during the day, I am looking at what's had a signal, and I can start chasing after them. And I've got things like Bible gap ups, pocket pivots, and I've got another radar screen that also is running on a different computer. So that's my list. That's my report for the week. We're at about an hour. Trade safe. Happy holidays. Drive safe. We'll see you next week.